This is a podcast from BFM 89.9, the business station.
8:48 a.m. You're listening to The Morning Run. I'm Shazana Mokhtar with Philip C. and Wong Shao Ning. Let's delve into the current landscape of U.S. interest rates and explore potential investment strategies. A few weeks ago, Federal Reserve officials chose to hold interest rates steady at a 22-year high, with the Fed fund rate at 5.25 to 5.5% after the central bank embarked on its most aggressive campaign in 4 decades, marked by 11 rate hikes in less than 2 years.
And data released last week provided a glimmer of hope in the battle against inflation as CPI was flat month on month in October. Additionally, producer prices experienced their most significant drop in 3.5 years. Now, these signs of subsiding inflationary pressures sparked a major rally on Wall Street as traders took this as a signal that the central bank will start cutting interest rates next year.
However, according to the minutes of the latest Fed meeting, they expressed a little appetite for cutting interest rates anytime soon. So how long will benchmark rates be kept at their highest levels in 2 decades? And what will the impact be on the performance of stocks, bonds, and other asset classes?
For more insights, we have on the line with us Francis Tan, investment strategist with UOB. Francis, good morning and thanks very much for joining us. The Federal Reserve did not raise rates at November's FOMC meeting as expected, but also did not rule out further hikes, with Fed Chair Jerome Powell keeping to his consistent view that they would be data dependent. With that, what are your expectations with regards to the Fed fund rate?
Well, my expectations for the Fed fund rate is that there shouldn't be any more rate hikes going from here. And if so, it means that the Fed has reached a terminal rate since the last rate hike to the 5.25 to 5.5 range in September this year. In July this year. The key reason is really because the inflationary environment in the U.S. currently do not justify any further rate hikes. However, as you have mentioned just now, it's really difficult for us to think when the next pivot, which is the rate cut, will come. For now, if we are looking at the interest rate futures market, they are expecting a potential rate cut from the Fed sometime in the second half of next year. However, over in UOB, we are thinking that they potentially can enact the first cut in the second quarter of 2024 and subsequently rate cuts in the third and fourth quarter, 1 rate cut each. So I personally think that the rate cycle in the U.S., not just this cycle, but over the past cycles, provide us with a very good glimpse of which part of this business cycle we are in. And usually when the Fed reaches its terminal rate and pauses there, and before the rate cut, we are somewhat in the late part of this business cycle. And if I'm going to divide it into 4 different seasons, we are somewhat in the autumn portion of this business cycle that really started in 2020 with the last recession.
Okay. But I'm curious then, how has the rising rates actually impacted the U.S. economy so far, especially from the consumer perspective?
Well, certainly rising interest rates is something that's not wanted by consumers alike, corporates alike, or even governments alike. With higher interest rates basically is the cost of capital, it's the price of money. With higher interest rates, I think generally people who borrow are going to suffer quite a bit. So over in the U.S., certainly we see that consumers, especially those who are leveraged, particularly for homes, or for other type of loans, they are impacted quite a very big way. If you look at the 30-year mortgage rates, it has hit a high of around 7.8%, although it's come down recently, but it's been working through the entire home ownership landscape in the U.S. Right now, overnight, looking from the National Association of Realtors information, the latest existing home sales have tumbled quite substantially, around 4.1% in October, and in fact that has tumbled to the lowest level in more than 13 years just in October. So what happens is that when interest rates are high, generally corporates who are leveraged or over-leveraged, consumers who are leveraged will be hit, and this in fact is what is needed or wanted by the central bankers, because they just wanted to slow down inflationary pressures. And in the U.S., housing comprises around 40% of the overall consumer basket. And if they can hit the housing sector lower, I think they are basically getting quite a good job done right now.
And meanwhile, with rates this high, which have been matched by a surge in 10-year US Treasury bond yields, what does this mean for other asset classes, especially equities, which have managed to hang on to their strong year-to-date gains?
Well, indeed, the U.S. Treasury bond yields have reached an all-time or cycle high. Although lately we have seen that the slightly more dovish Fed minutes, right, have been pushing the yields lower a little bit. So some of the asset classes that have been hammered quite heavily, particularly in 2022, are what we call long-duration asset classes, and those include the favorite technology stocks, the growth stocks, because these stocks generally don't provide a dividend, and being they are considered growth stocks. And from that angle, a rising interest rate is bad for them. But right now, with market expecting rates moving lower, and we are indeed seeing the US 10-year Treasury yields moving lower as well, asset classes that are long duration, growth stocks, tech stocks, I think they are going to be pointing higher. I'm actually more constructive and optimistic in this segment.
So, Francis, with that, what investment strategy would you adopt based on the U.S. economy? Is it going to engineer a mild recession, or are there headwinds ahead that we should be aware of?
Well, for one, we are, as I mentioned just now, we are in the autumn phase or late cycle part of this business cycle that basically just started in 2020. It's a very short cycle. In the past cycles, take any time around 10 to 12 years. This time around, really short. And by the fact that we're in autumn, we will be moving to the next step, which is winter. And winter in the economic parlance is basically a recession. Although I don't think that we are going to see a severe long duration recession like what we saw during the global financial crisis. I think it's going to be a mild recession. But as with all cycles, there's only one round. And although we can't exactly pinpoint to which month the recession will come, but at least knowledge that we are in the autumn and moving into winter is important enough for us to devise our investment strategy. So for now, a defensive strategy is very important. Yields right now are pretty high. Deposit rates, I know, are high, but they will not be high forever. As the economy in the world generally goes into the winter or recessionary period, rates will go lower, deposit rates will go lower, interest rates will go lower. As such, there will be what we call reinvestment risk, because by the time your deposit perhaps matures, you are not able to have a new tranche of deposit at a pretty high interest rate that we're going to see right now. So as such, we believe that a defensive strategy, locking in yields, fixed income will be one of the key asset classes to go into right now, particularly in the investment grade fixed income. Try not to move into high yields. Otherwise, government bonds are quite okay as well, protecting the overall portfolio. I will call this insurance or hedges against potential recession risk for investors' portfolio.
What about equities? Is it safe to put your toe into it? I mean, when you look at the US market, right, it is still all-time high. Doesn't it look, the valuations look rich?
Interestingly, the valuation is quite rich. This year-to-date, S&P has gone up around 18%, but guess what? 15% it came really from the top 10 market capitalization stocks. For the rest, 495 sectors or other stocks, they are really only reflecting the slowdown in the U.S. economy they are seeing. Top 10 market cap stocks in the U.S. are not predominantly U.S. Reflecting the U.S. economy. They are reflecting a global economy. So they have the globe as their key revenue driver. So with that, for stocks, since the U.S. or most part of the world will be moving into a recession, the defensiveness means that we shall not put too much eggs into the cyclical basket. That means cyclical stocks that will move in line with the economy. So there is a no-go. However, growth stocks, stocks in the technology sector, some of them in the consumer discretionary sector, those are okay. They react quite favorably to interest rate cuts. And otherwise, the other defensive pocket will be the healthcare stocks, utility stocks, and also the consumer staple stocks, which are generally quite non-correlated to the overall economic cycle.
All right, Francis, thanks so much for speaking with us. That was Francis Tan, investment strategist with UOB. This conversation was brought to you by UOB Privilege Banking, advice for what matters to you.
Okay, so some interesting revelations from this. Firstly, of course, is that we're in autumn. Winter's coming. But the good news is that this winter will be a rather short one, according to Francis. But we still need to prepare for it, right? So the point is, don't stay out of the market, be it in fixed income or equities, because then you run the risk of just, your money not working hard enough, and you can't really time investments. That's the main thing, right?
I think advocating a defensive strategy, right? I think that was what Francis was clearly advocating when pushing for.
All right. It's coming up to 8:59 in the morning. We're going to head into the 9 a.m. news bulletin. After the 9 a.m. news bulletin, we have the opening bell as well as international market insights with Carlos Casanova of UBP. Stay tuned, BFM 89.9.
You have been listening to a podcast from BFM 89.9, the business station. For more stories of the same kind, download the BFM app.